Welcome back to the Deep Dive. You know the drill. It's October 3rd, and time for our daily Bitcoin briefing. And, yeah, the market certainly delivered yesterday.
It really did. A lot of action.
Definitely. We're diving into a 24-hour period that was, well, packed with momentum. Our sources are framing it around these crypto-native catalysts.
Right, meaning the big pushes came from within the crypto space itself, not necessarily, broader market news reacting on Bitcoin.
Exactly. It felt like a convergence of internal factors.
Absolutely. You had institutional buying picking up steam, some really significant regulatory news landing, and all this while traditional markets are kind of grappling with uncertainty.
Okay, so let's start with the big number everyone's talking about. Bitcoin smashed through $120,000.
Yep, decisively. Closed around $120,321. That's a key psychological level, obviously, but technically important too.
And a 2-month high, right, kicking off October in style.
Pretty much textbook October start, yeah. But the mission today, I think, is to figure out if this is sustainable.
Right. Is this just a seasonal pop, or are these structural tailwinds strong enough to make 120K the new floor?
Especially with that macro backdrop still looking a bit shaky, we need to separate the real signal from the, short-term noise.
Okay, let's get into the mechanics then. Why 120K? What made the move so sharp?
Well, clearing that level itself builds confidence, technically speaking. But a huge amplifier was the liquidation pressure, or rather, the lack of it on the sell side.
Ah, the short squeeze.
Pretty much. We saw data indicating over $700 million in short positions got liquidated across the market, just in the first 2 days of October.
Wow, $700 million.
Yeah. Think about that. All that forced buying just removes sellers and adds fuel to the fire. It creates its own momentum upward.
Okay, so the shorts got cleared out, and then you add the institutional demand on top of it.
Exactly. That's the other side of the coin. The U.S. spot Bitcoin ETFs. I mean, the inflows there suggest the big players are really stepping back in.
What were the numbers?
October 2nd saw net inflows of $627.2 million. Just in one day?
Whoa. That's significant.
It's huge. Highest single day since mid-September, and it makes it 4 days straight with over $400 million coming in.
So what does that tell you? Is this just catch-up buying or something more?
I think it signals renewed conviction. We saw some outflows late September, maybe people hedging before the month end, potential government shutdown worries, perhaps. But this kind of inflow, it shows that, sophisticated investors aren't waiting around. They see the move starting and they're piling back in.
And that puts pressure on the market makers, right? They actually have to go find the Bitcoin to fill those ETF orders.
Precisely. It creates this really powerful positive feedback loop. Demand begets buying, which pushes prices, which pulls in more demand.
So demand side looks incredibly strong. Technically, where do we look next? You mentioned resistance.
Yeah, the immediate hurdle seems to be around $123,000. That's the next level to watch.
But the support looks solid now.
It does. Looks like a strong base has formed between, say, $115,500 and $117,000. Suggests this isn't just a thin rally that could evaporate quickly.
Okay, so if the technicals look decent and demand is strong, we need to look at the other side. Supply. Where are the coins coming from? Or not coming from?
Exactly. That brings us to the on-chain picture, specifically the long-term holders, or LTHs.
Right, the wallets holding for over 155 days, the strong hands. What are they doing? Because for a while there, they were selling, weren't they? Taking profits.
They were, yeah. Consistent selling into strength for much of the last couple of quarters. But what's really fascinating now is that behavior has just shifted dramatically.
How so? Are they buying again?
Not aggressively accumulating, not yet. But they've moved to what looks like a neutral stance. They've stopped the consistent selling.
Ah, okay, so the profit-taking is paused.
Exactly, and that cessation is crucial. It means a major source of patient, ready supply has just dried up right when ETF demand is surging.
Which connects to the exchange balances, I assume?
Perfectly. Bitcoin reserves on exchanges kept falling. Dropped to about 2.49 million BTC by October 1st.
So fewer coins readily available for sale.
Right. You've got these massive ETF inflows needing to source Bitcoin, competing for a shrinking pool of coins on exchanges because the long-term holders are deciding, nope, not selling at these prices.
That's the definition of a supply crunch meeting demand surge.
Textbook accumulation phase dynamics. It forces prices upward.
Okay, so restricted supply is one piece. Now let's pivot to a potentially new source of demand, or at least making it easier for that demand to step in. Corporations.
Yes, this was a big one, the U.S. Treasury announcement.
This sounds really interesting. Sources are calling it a landmark de-risking event for corporate adoption. What happened?
Basically, the Treasury and IRS put out interim guidance, couple of notices, 2025, 46, and 49, clarifying the Corporate Alternative Minimum Tax, the CAMT.
The 15% minimum tax on large corporations.
That's the one. And the key clarification is that unrealized gains on digital assets held by corporations will not be subject to that CAMT.
Okay, unpack that. Unrealized gains. So if a company buys Bitcoin and the price goes up, but they haven't sold it yet,
they don't have to worry about that gain triggering a massive CAMT liability on their tax return for that year.
Before this, they might have had to pay tax on paper profits.
That was the huge uncertainty. It was a potential nightmare for CFOs. Imagine having a huge tax bill due on gains you haven't even locked in by selling. It acted like a potential unpredictable liability hanging over the asset.
So this removes a major barrier.
A massive one. It makes holding Bitcoin on the balance sheet much more predictable from an accounting and tax perspective. It takes away a huge deterrent.
You think this could genuinely open the floodgates for more corporate treasury announcements?
I think it paves the way. Companies that were interested but spooked by the tax ambiguity now have clarity. It turns Bitcoin into a much more straightforward asset to manage on the books.
Okay, fascinating. So we have these powerful crypto internal factors, but we can't ignore the wider world, the macro environment.
Definitely not. And it's a weird environment right now. We're in this kind of data drought.
Right, because of the U.S. government shutdown. Oh, now in its third day.
Exactly. And the big casualty, information-wise, is the delay of the September jobs report from the Bureau of Labor Statistics.
Which is like the key data point for the Fed, for markets.
Absolutely. It's the main official gauge of economic health everyone waits for. Without it, there's this information vacuum. Uncertainty goes up.
So markets are flying a bit blind, relying on secondary stuff.
Pretty much. Like the ADP private payrolls report, which actually came in showing a small net loss of jobs, about 32,000 in September, but it's not the same as the official BLS numbers.
How does Bitcoin fit into this uncertainty? Does it help or hurt?
Well, this is where Bitcoin's unique properties arguably shine. When traditional markets are starved of reliable state-produced data, when there's what you might call informational ambiguity, Bitcoin offers something different. Its ledger is transparent, real-time. You can see the hash rate, you know the supply schedule's fixed, it's auditable by anyone. It provides a source of certainty in an uncertain environment.
So you're saying maybe a premium is being priced in because of the macro confusion. Bitcoin as a hedge against data ambiguity.
It's a plausible argument. When other systems lack clarity, Bitcoin's inherent transparency becomes more valuable.
Interesting take. Okay, speaking of value and price, let's touch on analyst views. JPMorgan put out a notable target.
They did. Very bullish, actually. They're targeting $165,000 for year-end 2025.
$165K. Wow.
Yeah.
What's the logic there? Is it just ETF flows or something else?
It's more fundamental, based on a comparison to gold, adjusted for volatility.
Okay.
They noted the Bitcoin to gold volatility ratio has fallen quite a bit, down to 1.85. Historically, it's often been above 2.0.
So Bitcoin is becoming less volatile relative to gold. What does that signify?
It suggests the market is maturing, pricing Bitcoin with a bit more stability, perhaps. When that volatility ratio drops, its risk profile, viewed through that gold lens, looks more normalized.
And based on that normalization?
JPMorgan's model estimates that, based on this lower relative volatility, Bitcoin is currently undervalued compared to gold's market cap by about $46,000.
So just to reach a fair value relative to gold at this new volatility level, it needs to go up another 46K.
That's the gist of their argument, yeah. It suggests a significant move is needed just for parity on a risk-adjusted basis.
Okay, let's shift gears slightly. Look under the hood at the ecosystem's plumbing. The integration with traditional finance, or TradFi.
Right. This is crucial for long-term health, and we're seeing progress on two fronts simultaneously, which is interesting.
What are those fronts?
First, you have the crypto-native players building regulated bridges into TradFi. Like 21X announcing plans for a regulated, blockchain-based trading venue in New York for tokenized securities. They've actually filed with the SEC.
So new infrastructure built from the ground up, but aiming for full regulation.
Exactly. And then second, you have the big incumbents, the existing financial giants, integrating blockchain from within.
Like who?
SWIFT, the global interbank messaging network. They've partnered with a huge consortium, over 30 banks, including big names like BBVA.
What are they building?
A shared blockchain platform. aimed at real-time international payments and settling digital assets. So using the tech to improve their existing services.
So you've got the disruptors building new regulated paths and the incumbents adopting the tech themselves.
Precisely. It's convergence from both sides. Both approaches validate the underlying technology and strengthen the infrastructure needed for digital assets to really integrate into global finance. It's not just one or the other. It's happening concurrently.
Makes sense. And quickly, what about the miners? The foundations securing the network, are they healthy?
Yeah, September production reports looked solid. MRA Holdings mined about 736 BTC, Kengo Inc. around 616 BTC. Both showing decent output.
But network difficulty keeps rising, doesn't it?
It does. Global hash rate and difficulty were up around 9%. But the key takeaway is that these major public miners are still managing to grow their own production and operational hash rate.
Like MARA hitting 60 EHs.
Exactly. Their ability to keep investing, keep growing their operations, even as it gets harder and more competitive globally. That signifies a really robust, well-capitalized industrial base securing the network. That's fundamentally healthy.
Okay, so let's try and synthesize all this. It feels like a really potent mix right now.
I think that's the right word, potent. You've got this surging institutional demand clearly visible in the ETF flows.
Meeting a newly restricted supply as the long-term holders pause their selling.
Right. And then you layer on top this potential new wave of corporate interest, significantly de-risked by that SHIAMT ruling.
It sounds like a very bullish foundation.
It does. But connecting it to the bigger picture, we have to be aware of the risks too, of course. Nothing goes up in a straight line.
Okay, what are the main risks to watch?
Well, first, just technically, the rally has been very sharp, very vertical. It might be a bit overextended in the immediate short term, vulnerable to a pullback or consolidation.
Standard market dynamics. What else?
The macro risk hasn't vanished. That data drought will end eventually. If the delayed jobs report or other data comes out and it's really bad, worse than feared.
Could trigger a wider risk-off move, pulling everything down?
It's possible. A flight to safety could temporarily hit risk assets like Bitcoin, even if its long-term narrative is strengthening.
And any specific crypto-related risks on the horizon?
There's an SEC decision coming up October 5th on the 21 shares Zcash ETF application. While it's not Bitcoin, any unexpected SEC action, positive or negative, especially regarding privacy coins, could cause some volatility across the broader crypto market that might spill over.
Got it. So strategically, for someone trying to track if this rally has legs, what are the key metrics?
I'd keep it simple. Watch two things daily. The ETF flow data. That's your best real-time proxy for institutional appetite. Is it staying strong?
Okay, ETF flows. And number two?
On-chain data, specifically that LTH behavior. Are they continuing to hold firm, or do they start taking profits again if the price pushes higher? That tells you about the underlying conviction of the long-term base.
So sustained ETF inflows plus stable LTH positioning equals a fundamentally supported rally.
That would be the ideal scenario, suggesting this $120 K level could indeed become a durable floor.
Okay, brings us to a final thought then. You mentioned the CAMT ruling potentially opening doors for corporate adoption.
Yeah, the immediate test now is whether that regulatory clarity actually translates into new corporate treasury announcements soon. That would establish a whole new fundamental demand floor.
And maybe a provocative question for you listening. The report implies that in this foggy macro environment, Bitcoin's transparency offers a kind of certainty traditional data currently lacks.
Right. So if that informational ambiguity in TradFi persists, how quickly might corporate boards, now less worried about the tax angle, start seeing Bitcoin's predictable certainty not just as an asset, but maybe as a primary non-negotiable balance sheet requirement?
A shift from speculative asset to essential reserve based on certainty.
Yeah.
That's definitely something to think about. We'll have to leave it there for today's deep dive.
Lots to keep watching.
Absolutely. Thanks for tuning in.